Shrinkflation. The price stays exactly the same. The product doesn't. The cereal box is taller, but the bag inside is half empty. The chip bag has more air than chips. Peanut butter jars have quietly lost over a third of what used to be inside them, while the label, the shelf price, and your habit of not checking stay exactly the same. Nobody announces this. There's no press release that says you're now getting less. It happens in silence, ounce by ounce, until one day you realize the box that used to last a week now runs out in 4 days, and you assumed it was you eating more. You think your appetite changed. The product did. The payday loan. You need $300 before Friday. A payday lender offers it. No credit check, no long forms. Cash today. The fee looks small, $45. What doesn't get said out loud is that $45 on a 2-week loan is an annual interest rate north of 300%. You pay it back, but now you're short again, so you borrow the same $300 again and pay another $45. Payday lenders drain over $2 billion a year in fees from people who had no better option in the moment they needed one. The loan was never designed to be paid off once. It was designed to be renewed. You think you borrowed $300? You actually rented it forever, one Friday at a time. The free trial that isn't. Try it free for 30 days is one of the most profitable lies in modern business. Not because it's false, but because of what happens on day 31. The trial ends, the card gets charged automatically, and the reminder, if it comes at all, arrives buried in an email you don't open. Researchers have a name for this too: forced continuity. The company isn't betting that you'll love the product. It's betting that canceling will feel like more effort than it's worth, so you'll just keep paying. You think you signed up for a trial? You actually signed up for a subscription with a delayed start date. Drip pricing. An airline shows you a $79 flight. You click it. Then one screen at a time, the real price drips out. A seat costs extra, a bag costs extra, boarding earlier costs extra, and somehow by checkout you're paying $210 for a flight that was never $79 to begin with. This isn't a mistake. It's engineered. Behavioral designers know that once you've invested 5 minutes typing your name and card number, you won't start over on principal. You'll just pay it. The $79 was never the price. It was the bait, and you were already hooked before you saw the hook. You think you're comparing prices. In reality, you're comparing decoys. Encore pricing. You see it everywhere. Was $199? Now $89. Feels like a steal. Except that $199 price rarely existed in any meaningful way. Sometimes it ran for a single day right before the sale started. Sometimes it never ran at all. It's not a real price you missed out on. It's a number placed there on purpose. So the real price standing next to it looks like a win instead of just a price. Retailers call it a reference price. Your brain calls it a bargain. Once you've seen the $199, $89 feels cheap, even if $89 was always the actual price. You think you're comparing a deal to what it used to cost. You're actually comparing a real price to a number invented specifically to make it look small. The minimum payment. Your credit card statement says you owe $3,000. The minimum payment is $60. That number feels safe, affordable, responsible even. Here's what it doesn't tell you. At an average interest rate north of 22%, most of that $60 is swallowed by interest before it ever touches your actual debt. Pay only the minimum, and that $3,000 can take over a decade to disappear and cost you nearly double what you originally borrowed. The bank didn't design the minimum payment to help you get out of debt. They designed it to keep you exactly one step away from it forever, for as long as you're willing to keep paying. The junk fee. A junk fee is a charge that doesn't exist until the exact moment you can no longer say no. You book a hotel room for $140 a night. Feels fair? Feels final. Then you get to the desk and there's a resort fee. You never use the resort. You didn't ask for the fee. It doesn't matter. You're standing there with your bags, and walking away means losing the room you already committed to in your head. Regulators have a number for this. Americans lose tens of billions of dollars a year to charges that only get revealed after you're already locked in. The fee was never about the service. It was about the timing. You think you agreed to a price. In reality, you agreed to a trap disguised as a price, Sprung the second retreat became more expensive than surrender. The pre-checked box. You sign up for a loan, a subscription, a new bank account. Somewhere in the form, a box is already ticked. Credit monitoring, purchase protection, some add-on you never asked for. You're not lied to. You're just exhausted, scrolling fast, trusting the default. Companies call this a sneak into basket. They know most people never uncheck what's already checked because unchecking requires noticing, and noticing requires slowing down. And slowing down is the one thing checkout screens are built to prevent. Every month after that, a charge appears with a name you barely recognize. You think silence means consent. The company is counting on you thinking that. The overdraft trap. Your account dips a few dollars into the red. The bank could just decline the charge. Instead, it helps you, covers it, and charges you $34 for the privilege. One coffee turns into a $34 mistake, and banks don't always process transactions in the order they happen. Some process the largest one first, which can trigger multiple smaller overdrafts instead of one. In a single recent year, Americans paid over $12 billion in overdraft and NSF fees combined. The bank calls it a courtesy. The math calls it a business model built entirely on your worst week. You think the bank is protecting you from embarrassment. It's charging you rent on your own mistake. The loyalty penalty. New customers get the best deal. The people who've been paying on time for years without complaint, without threats, quietly get charged more for the exact same service. Insurance premiums creep up every renewal, even with zero claims filed. Your cable bill climbs every year unless you call and threaten to cancel. The real discount only exists for people willing to walk out the door. Companies know something about you. Loyal customers rarely shop around, rarely check competitor prices, rarely question a bill that just goes up a little every cycle. So they charge the quiet ones more and save the good deals for the customers threatening to leave. You think staying loyal saves you money. It's actually the reason you're paying more than the stranger who just signed up yesterday. Skimflation. This one's sneakier than shrinkflation because nothing gets smaller. It just gets worse. Same price, thinner toilet paper. Same price, a hold music customer service line that used to be a real person. Same movie ticket, but the theater's dirtier and the seats are worn through. You're not paying more for less product. You're paying the same for less quality. And quality is invisible until the day it fails you, and you finally ask why this used to feel better for the same money. You think prices held steady. What actually happened is the company quietly downgraded everything you can't put a number on. None of these people robbing you wore a disguise. They wore a checkout page, a pre-check box, a courtesy overdraft, a shrinking bag that still says family size. Every single one of them is legal. Every single one of them is designed, tested, and refined by people whose job is to make sure you don't notice until it's too late to say no. You didn't get careless with money. Money got engineered to leave your account before you were paying attention. And the only real defense you have is refusing to stop paying attention again.